Hello and welcome to a brand new show of Market Makers. It's been an incredible comeback for Indian markets. Dow is striking distance away from an all-time high. We've seen a breathtaking rally and a trail-blazing move in benchmark indices, and Nifty has added more than 1,000 points from the budget day's low. Concerns are getting healed. Markets are ignoring bad news, and so far we are off to a good start for the earnings season. So for the moment, it appears that if you are long, you're on the right side of trade. But the question to ponder over now is that how much more, and is this as good as it gets? So to talk about stock, ideas, sectors, and the market behavior, I have with me the perfect guest, Hiren Ved, normally a bullish guy, and he's been bullish and he's been right. Hiren, fantastic to have you back, and thank you for joining us. What's going on? I mean, markets have been so fickle. Before we understand the trend changes again.
Yeah, I mean, nowadays we have these cycles which are much shorter than what, earlier you used to have reasonably long cycles. If there was a bull cycle, you had like a 6, 8, 9 months of markets moving up, but now everything changes in a couple of months. Yeah, I think Jan Feb was the epitome of global concerns, and the markets went down more because of fears of a Fed rate hike and the fact that the Chinese currency might depreciate very aggressively, and then obviously there was fears around our budget in terms of whether there are long-term capital gains tax, but none of those fears have come through. Yeah, the Chinese currency is stable. The dollar, which was appreciating, started to depreciate after the G20 meetings. And the Fed has kind of laid off any immediate hike in interest rates. So you've seen markets come back pretty aggressively.
So markets are repricing risk, and markets are again repricing the way they're approaching banks now. If I take the clock back 6-8 weeks ago, we were discussing NPA concerns, balance sheet contraction, poor credit growth for banks. Today, we are all discussing the other end of the spectrum. I mean, the way banks have made a comeback looks like there are no problems in the world, and NPA is a history.
Yeah, I mean, actually, I don't think most of those problems are really solved. If you ask me, I think the credit growth is still very, very tepid. The only thing that has changed is that probably, the AQR came as a kind of a surprise, right? And then investors said that if this is what AQR is, then we don't know how much more is there and whether there will be a second AQR list, and then what happens, right? So the market started to price in banks, assuming that these new provisions would have to be made. And now today we have a situation where where the RBI is selectively saying that, okay, now here I am seeing some progress in these 20 accounts because these guys have gone and sold their assets, and probably they're not going to default as what we thought about, and then you may not provide for it. I'm a bit surprised why the Reserve Bank did this, but my sense is that they probably don't want to get to a point where the average depositor takes confidence away from the banking system. Right. I mean, you don't want a run on the banks, and you want to be strict, but you don't want to be so strict that you put the system under stress. And I think the system did come under quite a bit of stress, and that's why in the latest monetary policy, they essentially, while he cut by only 25 basis points, but he did a lot of stuff for improving liquidity in the system, because the liquidity in the system has really, dried up. So my sense is that he probably thinks that he's delivered the message, but you don't want to push the banking system so much that it creates a crisis of confidence.
So the problems are getting healed, problems are getting addressed. Case in point here is that Vijay Mallya is ready to negotiate. He does not want the tag of a willful defaulter. So problems are getting addressed, but we may not be at the cusp of a new cycle. Now, last time when we interacted with you, you said that you like private banks. And within private banks, you like retail-dominated private banks.
Yeah.
But is it time to change positioning now? Can ICICI Bank in the short term make more money than HDFC Bank?
Possibly. Because, I think that the valuations were beaten down far more aggressively and HDFC was always, or the better run private banks were always priced for the fact that they don't have an NPA issue, that the fact that they are doing very well, and you had priced an extremely negative scenario on the other side of the spectrum, right? So when things start to incrementally improve, obviously you're going to see a snapback. And then it's also somewhat a little bit technical, right? Because most of the shorts are also on that side of the spectrum. And then when these things unwind, in the shorter run, you might get a quicker rebound.
So
on a longer term investment thesis basis, I would still go with the former, because I think that the ability to have a good balance sheet, an unconstrained balance sheet, you are better off taking away market share from the PSUs who may not be lending right now, right? So longer term as an investments theme, you stick with that. But in the short to medium term, you could have some of these banks which got battered down very badly, bouncing back quite aggressively.
That tactical trade in State Bank of India, is that over? And for those who did not buy State Bank of India, let's say closer to 150 or 140, have they missed the boat?
Well, it depends. I mean, it depends what kind of an investor you are. If you are looking at catching the absolute bottom, then probably, hopefully you missed. I mean, I would think that that was what the worst could have been priced in. But if you are somebody who's looking for more visibility to figure out whether on a structural basis things have changed, I mean, the road is quite long ahead. So, whether you buy at 150 or whether you buy at 180 or 190 doesn't really matter.
You don't own State Bank of India?
No.
And you have no plans to buy State Bank of India?
Not as yet.
You liked NBFCs in the past, and
yes.
some NBFCs have really worked like a charm for you. Great identification, brilliant identification of a stock like Bajaj Finance. At 7,000, do you think Bajaj Finance is a stock you would still like to buy for the long haul? And when I say long haul, I'm talking 3 and 5 years.
Yeah, I mean, I think that now a stock like Bajaj Finance has reached a point where the market has rewarded it for the strong growth and very high asset quality and a very well diversified book, right? So to assume that the market will price it more than 4 times price to book would be stupid. So I think what you can now get is what the earnings growth will be. So I think that there is, there's the scope for multiple expansion is not there. I mean, that was 3, 4, 5 years ago.
Earnings are still growing for Bajaj Finance, but north of 20%.
Yeah, I mean, earnings will still grow at 20-25%, right? So that's the kind of return that you will continue to get from a stock like that, which means that stock price will now compound at the rate at which earnings compound. That's not a bad compounding.
So Bajaj Finance has been a 8x for you, 10x for you?
Yeah, I mean, it's more than 10x.
So you've not sold your core holding in Bajaj Finance?
No, we haven't.
And you have no plans to sell it for another 3 years, as of today?
No, I mean, we thought when recently the valuations went up whether, we should take an overlook. But I think that they're just doing a fantastic job. I think they're just going to enter a new phase of growth. I think they have a credible plan to take their balance sheet size from 35-40,000 crores to 75-80,000 crores. So they have a credible plan how they want to double their size from here over the next 3 to 4 years. So I think there is still a lot of scope and opportunity to remain invested in a stock like that.
What do you make of the first flush of IT numbers we've got? And the picture, at least according to me, is very divided. Wipro, no hope. Infosys, lot of hope. TCS, more like a median stock.
Yeah, I think they've all reached a size where now it's basically you'll have to take each stock individually. I mean, they're all going to grow. I sometimes wonder, because everybody says that they're going to grow faster than NASSCOM. Then who's going to grow at NASSCOM or below NASSCOM, right? So I think that the big IT industry is in a transformative phase, right? So the phase where you grow organically by just growing the number of employees is probably going away, and you have to generate higher productivity per person, which is the language that everybody is talking about. Infosys, TCS, that they're investing in automation, that they're going to faster after faster markets like digital and stuff like that. So I think, organically they'll probably grow in that 10, 12, 13% range. The only thing is that all of them have humongous amount of cash in the balance sheet. So if they do have the ability to acquire, good consulting companies or good technology companies and then grow faster, that would be very interesting. I think the thing is, the thing about the big tech companies is that you need some exposure in your portfolio because they're good, solid companies, and it's a great hedge if the dollar is going to, if the rupee is going to depreciate against the dollar, right? So, so they are good, solid companies to have. You may not be overweight, some of these big names, but in a long-term portfolio, it might be good to have one or two of these good names there, purely as a hedge against, very volatile currencies, because that's what we are seeing nowadays, that, currencies really go very berserk. I mean, all the macro imbalances get reflected finally into currency valuations. So I think to that extent, they have a role to play in a long-term portfolio. But I think the fun is going to be in the more specialized, smaller, companies, or the mid-sized companies, which are more tagged to end sectors which are growing faster. So whether it is engineering services, whether it is digital, so on and so forth. So I think that's where you can hope to make a slightly higher return than the biggies.
A couple of quarters ago on a similar forum, we discussed why do you like Damatic Technologies. Your core thesis of that business, that understanding of the company is still intact?
Absolutely. I think there are, what happens is that every few years, these small companies, to take the leap to the next level, have to go through a lot of churn, because there are a lot of moving parts, right? So you had the hydraulics business, which was struggling because tractors was not doing well. Now that's come back. You had the automotive business, which was not doing well because autos were not doing well, but that's slowly coming back. And the aerospace business, which is where the big bet was, I mean, they always had the orders, but I think starting from this quarter onwards, you will start seeing the ramp up actually happening. So I think the next 2-3 years could be very, very exciting and interesting as they just execute on the businesses that they've got on the aerospace side. They don't need to do anything, just keep their head down and just execute the business. And then there is the cyclical part of the business, which is the tractor and the auto business, which will give them a leg up, which actually took them down in the last couple of years because those sectors were not doing well. So I think the base has been built, and we should look forward to sustained growth over the next couple of years. And the opportunity in the defense and aerospace continues to be as big as it is. I mean, this government.
So that is your defense bet, basically.
Exactly. Apart from others, I mean, we do also have exposure to stocks like BEL, which are also very well placed, to take advantage of the. And
the order books for BEL are ballooning, and we know that it's more than a deep swell. I mean, that's structural in nature.
It's a structural call in.
What do you make of the price action in commodities? Just a deep swell, or the tide has turned?
Well, it looks like that for the time being, that they seem to have bottomed out for the time being. Whether structurally are we still in a bear market in commodities, the long-term structural bear market in commodities, I would think so, unless there is evidence that global growth is picking up back again, right? So this is basically those mini cycles within a big trend where you see things coming off the bottom. Obviously, I was reading that yes, people have now upgraded China growth forecast in the second half of the year. So I think China, after going after their real estate sector, deflating it, they are now reflating those sectors again. So I think these are all very highly correlated. I mean, if the outlook on China improves, then automatically the outlook on commodity improves. But my sense is that the long-term trend could still be largely down. So within that long-term trend, you may have ups and downs in commodities, because unless and until a large part of the globe starts to grow again, it's very difficult to think that commodities could be in a long-term bull market again. So that's my thesis, but I could be wrong. I'm not an expert on commodities, but that's the feeling we get. Because, I mean, you had the Atlanta Fed coming and saying that US GDP growth is going to be 0.2%, and so we are scaling down from 2.5% and 3% growth for the US economy down to now less than 1% growth. So, and Japan isn't growing; it's still contracting. I mean, China is growing, but it's off a base which is very high. So so where is the growth? I mean, Europe is struggling. So I think it's more the movement in commodities is also more a dollar play. So the dollar was strengthening, now the dollar has weakened, and therefore the commodities are up. How long these trends will sustain, it's very difficult to make.
Let's talk about your newsletter. I've read some of your newsletter. A lot of newsletter, they talk about what's gone wrong in the past, but your newsletter often talk about what lies ahead. Yeah. So what lies ahead in the second half? What are you communicating to your unit holders?
See, what we are telling our investors is that, obviously the recovery has taken much longer. There were a lot of factors which elongated the recovery, economic recovery, right? And many of those factors are now turning around. Obviously commodity prices was one of that. I mean, because 35% of your Nifty earnings are sensitive to commodity prices. So you had a continuous deflation that has changed. Now, if banks are not going to be providing as aggressively as people thought, then you could get a leg up in your earnings because of the banks. We are seeing movement in cement because of road building. So very clearly, cement demand has started to move. Commercial vehicles anyway was doing well. Two-wheeler numbers were good. Now, some people argue that we shouldn't get too excited because the base last year was very, very bad, and that we have to see whether some of these things sustain. So I agree that we need to see whether some of these green shoots that we've been talking about will sustain. My sense is that any recovery is never broad-based to start with. It always starts in bits and pieces, and then over time it gains momentum. What you have to figure is that whether around you there are factors which could build up, which could help you to broaden this green shoot recovery. And I think those factors are aligning together. You do have inflation which has come down consistently. Yeah. The bias of the central bank is towards easing, improving liquidity in the system. I think the government is, the lag effect of government spending on roads and stuff like that is beginning to kick in. And we are also talking to consumer companies that the consumer is back, the urban consumer is back buying things, and Jan Feb was extremely bad, but I think March and April are looking better when they're looking at footfalls coming in and demand that is being driven. And I think some of that aggressive discounting by the e-commerce guys, which kind of impacted the traditional trade, is now lessening because the money for them is drying up, and they are also focusing on improving profitability at the margin. So I think you could see, I don't think it's going to be a V-shaped recovery, but you will definitely see a slow recovery happening in India. And I think to some extent the markets are beginning to price that in. But hopefully, I think what is very critical, we need to get this one good monsoon that, obviously they've all come and said that statistically, probability wise, we should get a very good monsoon. So indeed, if we do get a good monsoon, then I think you could see a leg up in the second half of the year. You should see the economy really picking up steam. and then hopefully, you build on that and move.
We've seen a 10%, more than 10% recovery from the budget days low.
Yeah.
So to expect another 10% from here in this year, will that be a tall watermark, a high watermark?
I would say we are somewhere in the middle of the range, or slightly, we've slightly been above the middle of the range, because we still have to see earnings, whether they pick up or not. I mean, I'm confident they will, but we still have to see that. And if over the next 1 or 2 quarters, if we do see that the earnings start to pick up, then maybe another 10% is also not such a big deal.
But this
if
is
that
not like a
doesn't
mega bull
happen,
market. This is not like a mega bull market what we saw between 2003 and 2008, where the price action was linear.
yeah,
You will think the direction is higher, but it will be a grind up.
I think it'll definitely be a grind up, and we have to understand that 2003 to 2007 was a Goldilocks kind of situation. I mean, you had global growth tailwinds with you, right?
Power sector, commodity sector,
Everything.
low inflation, high liquidity.
High liquidity, credit boom, global economies were, chugging along fine. All of these are headwinds to you today, right? And you're trying to move against the wind. So there is only that much momentum that you can that you can pick up. I mean, I know it's all very good to say that we are the best amongst the lot and we are growing very fast, but I think our experience in the past has shown that you need some global tailwinds to help you to keep growing sustainably.
So if I have to really capture today's the essence of today's show, your messaging to our viewers would be, and to your investors, is that keep up, remain positive, keep return expectations low. 10 to 12% upside even after the recent run up cannot be ruled out.
Yeah, I think so. So I'll tell you what, I mean, what we've been telling people is that, look, I mean, if you look at the last 5 years compounding of the markets, they are below the long-term average, right? So the long-term average of the Nifty or the Sensex return is about 15-16%. Last 5-6 years, you've been below that average. So you will get a phase when returns are above that average. Now, whether it is this year is the turning point, looks like that this year could be a tipping point where earnings recover and you start seeing that recovery. Now, typically in the first phase of that recovery, you typically get certain front-loaded returns, right? So I think that it's, I think that given the fact that the global uncertainty still exists, global growth is not good, keep your expectations reasonable. But I still feel there is money to be made. And now within a 3 to 5 year cycle, don't try to be too cute about timing it that, now the market will go up.
For next 3
Stay
to 5
invested.
years.
In this 3 to 5 years, you will get one cycle which will be phenomenal. I mean, you wouldn't have expected. I mean, the markets would be up 30% or something like that.
That could happen this year, that could happen next year.
Yeah, I don't know when in the next 3 to
5
5 year cycle, sometime between now and 2018, 19 or 20.
Lay your bets right now and position yourself for that.
Position yourself. Don't try to be too smart by trying to, time the market. You will get one good cycle. Because it's been so difficult for people to get hold of these mini cycles, as I said. By the time you are ready to position for the cycle has already turned. So, that's not your game. Your game is that, you have below average returns for the last few years. You will have a phase of above average returns over the next few years. And then you will get a 1 or 2 odd years where you'll make up for all the patience that you've kept so far, and that's the way to play the game.
That's a great point. That stay in the game, stay invested, and just prepare your portfolio for that big uptick. So good luck for FY17. Glad you could join us, and thank you so much for your time. That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.